Welcome to the show. Thanks for tuning in. Today we have Nicholas Pardini. We've had Nicholas as a guest before. He is our recurring guest speaker. And Nicholas is the founder and chief macro strategist at Davos Investment Group. And he created the fund at only 29 years old. And he has a new YouTube channel. So we're so happy to have Nicholas here today. Nicholas, welcome to the show.
Thank you, everybody. Just before, just as disclaimer, like nothing that I say in advance, this is specific investment advice. It's just kind of general strategy.
Yeah, and Nicholas, can you just share with everyone like how you got into learning about investments and starting your own management company?
Okay, well, I originally got into investments because I talked about this last interview I was on with you, that my grandmother gave me stock instead of cash for my 11th birthday, and I was curious about what it was, and then she later taught me a lot of the basics of my original approach to investing was more of a value style, and then after that, I worked under a hedge fund manager as an intern and during college. And then I slowly worked my way up working at various buy-side firms across California until I started my own 3 years ago.
And congratulations, because that's amazing to start your own company and you're doing extremely well. And Nicholas has come back on the show to, we have a lot of young listeners, new people that are learning about startups and investing, whether you're investing in a company yourself or in stocks. And so Nicholas, I want to ask you, during COVID, what was the biggest, do we say trend that you've seen as an investing strategy?
Like in terms of what I think is the most longer term staying power, or what worked well for the past 6 months? So those are two different questions.
Let's do both questions.
Okay, well, what's worked really well originally was, I say prior to the release of the vaccine news in November, was the revival of the whole growth tech, stay-at-home bit, and deurbanization. That's probably that might be the longer term trends. People are moving out of places like New York and San Francisco, and to a lesser extent Los Angeles, and a few of the big, crowded, expensive cities to places where they would used to have vacation homes, but due to being able to work remote, they'll be there full time. And this has driven a housing boom across the country, especially in some of these more underserved second-tier cities. I mean, in terms of smaller populations and more room to build, not in terms of the quality of the city itself. So that's the trend I think is going to continue to go, because a lot of millennials want to start families and it's not financially viable in some of these cities. And due to work remote, you can now have a high paying job in a lower cost of living place. And so that trade is being made. As you've seen, the lumber market has tripled in price over the last year because of just the crazy demand for building new houses or adding to existing ones across the country. So I think housing is probably the longer term trend. Home builders outside of technology have been one of the best performing sectors in the market the last several months.
The lumber builders?
No, it's home construction, whether it's the companies that directly build houses or companies that supply things that are normally part of home construction, such as like Pool Corporation, which makes swimming pools, Lennox and Carrier, who build air conditioner and heater systems. That whole industry of building new houses and people moving. And U-Haul has been one of the best performing stocks because a lot of people are moving out of apartments to single family homes or from more expensive cities to more affordable ones.
Yeah, and I saw that Amazon is trying a white glove moving service. Not that everyone that's moving is white glove, but yeah. So in Los Angeles, even though a lot of people seem to have moved, a lot of empty units, they are tearing down old duplexes and apartment buildings and building brand new, spankly new buildings. But my biggest thing is since a lot of the gig workers and hourly workers have lost jobs, and a lot of job reductions as far as just jobs for people that are just regular hourly workers, how do they afford these brand new kind of homes? Do they have to move to a smaller location, which people are saying, like my friend in Tennessee said the prices have tripled in Nashville, Tennessee, and some of those places as well.
Well, I mean, that's what the lower classes do is always like more of a social problem than an investing problem. But there's really two ways this historically gets solved. Rents are going to go down because there's less, and they have been going down in major cities. And compared to home prices, they're at lows last seen during the last housing boom in 2004 to 2007. So either they'll be able to have lower rents, or like what happens when a country's living standard overall falls, which is the bear case, is that people just have to live in worse quality conditions. Like if you were, for example, like you could say a lower middle class family 50 years ago could afford to buy a house on a one income earner. Maybe 20 years ago, that lower middle class could afford to buy a house on two income earners. Now that lower middle class couple probably needs both their incomes just to rent an apartment. It's just the decline. That's a simple decline of living standards. So the optimistic case is rents fall because more people are moving out of apartments, and so the ones left over will be cheaper. The pessimistic scenario is that the living standards of the lower 20 to 25% of its population are going to more resemble a third world country.
It's in Los Angeles, the rents are still pretty high. The situation is not the best, I would say, but I don't have any of the statistics on that. But let's see if we can talk about something positive. So during COVID, are we coming out of COVID sort of? Is there a difference in the stocks that like you said, like you see, I see construction every single day in Los Angeles. Something is being torn down and something new. It's just those cement trucks just everywhere there's construction going on. And is there any different kind of a strategy now that we're possibly coming out of COVID with the vaccines, even though like you hear things positive and negative with the vaccines, like there's the algorithms aren't letting you hear like the stuff that you probably should hear. You should probably know the good, the bad, and the ugly on anything, but just seeing if there's a change, an investment strategy coming up.
Well, the tricky part is a lot of the vaccine reopening trade has already taken place. When November 9th, 2020, when Pfizer announced its successful vaccine test, that was the start of the great rotation away from technology to value. And so a lot of these companies that were trading really cheap, like airlines, hotels, consumer recreational activity companies such as theme parks and family daycares, they all rallied immensely. And oil too. Oil stocks rallied a lot too. Those are a derivative of a lot of the travel industry that was shut down. And so you've seen that recovery already. So the market is already anticipating a full reopening. So if you're going to trade that now, you're probably behind the curve. The thing is that what's tricky in this market is almost everything is trading at a premium right now. So you have to be very careful with your timing on things. Like if you do get a substantial correction in some of these reopening stocks, there will be some that do look attractive, but I think the opportunities are more idiosyncratic and like specific special situations, which I do not elaborate on publicly.
Okay, and then can you talk about talk about a little bit on like these trends with the cryptocurrency and the Bitcoins and the NFTs? Do you see that still booming? Because there's some new regulations that the IRA is, coming down on it, but you also hear the news like some countries are coming out with their own Bitcoin. Is there any kind of opinion you have on the cryptocurrency?
Yeah, my view on crypto is probably going to have your audience not like me very much. But I mean, I'm not a very big fan of cryptocurrency as a whole. I think this is just a key lesson. I think for a lot of your listeners need to learn about the difference between investing and speculation. I did a video on this on my YouTube channel, Ask a Macro Strategist, that goes into more detail, but there is a difference between investing and speculating. Investing is you buy something that you expect to earn returns from the cash flow generated from the investment. So if you buy a house, an investor invests in a house to collect return from rents of somebody if they rent out the house to somebody. Or like you buy stock, you're betting on the future cash flows of the company to get a return on investment through dividends, or the company investing that money to grow into a bigger company that generates more future cash flows. Something like cryptocurrency or even commodities, you're betting on just physical scarcity, that there's like only a certain amount of limit and there's going to be more end uses for it. Whereas with bonds, it's the same thing. It's interest payments. But with cryptocurrencies, theirs are more speculation. It's the equivalent of gambling. You could win in gambling. There's people who win in the casinos. But in the longer term, the odds are probably against you, and there's really not much of a way to predict edge on which cryptocurrencies are better than others. I'm not a crypto expert. It's not really my field of expertise within the marketplace. However, I'm skeptical of the whole scarcity idea of cryptocurrency, because if Bitcoin's main strength is that there's only 21 million Bitcoins, why does Dogecoin have a value at all? Shouldn't there only be one cryptocurrency if scarcity is the main argument? And since something like Dogecoin, which was literally created as a prank by the coders who built it, has a value of tens of billions of dollars, it means that really none of them have value, because anybody can create any copy of a crypto and just market it correctly, and maybe they'll get a bid. This is what's popular among several speculative manias that have gone on in the financial markets the past 400 years, whether it's tulips, whether it's tech stocks, whether it's railroads. Well, there's always something that captures the imagination in the previous cycle, and a lot of people end up losing a lot of money. And I think crypto is this generation's big speculative gambling den.
So yeah, well, because a lot of people love it, like they're crazy about it. Like our millennials love it. A lot of people ask for people to talk about it on Girls Guide to Investing. We have so many guys listening. We have a lot of girls listening. We have different countries around the world listening, and so it's important to learn. Like I think it's important to get all sides, all views.
I mean, you could make money on crypto if you trade it like technically via like chart patterns, or like have very defined risks. But again, that's more like the only real reason why those things move up or down is just pure psychology and beta. So there's no cash flow underlying it. So and if you think that maybe the world will end and then the dollar will collapse and all be replaced by Bitcoin, yeah, I can respect that opinion, but that doesn't mean it's certain. There's just a gut feeling to it. It's just kind of my view on it is that if you're going to put money in crypto, only put money you're okay with. If you're wrong, losing all of it.
Yeah, so that's good. That's good. Very good advice, because investing is very risky, and a lot of people feel like that left out syndrome. Like, oh, I invested in this, and people like, oh, they feel left out, or they feel like they're getting behind, because a lot of things just become popular, right? Like it's like popularity, like. Tesla.
Yeah, I mean,
Tesla bought Bitcoin. Oh, Tesla likes it. Then, we gotta like it too. Elon Musk. He invested in it, right?
Yeah, that's what makes it so flimsy. Literally, if you have a few tastemakers like Elon Musk change their mind, or Elon Musk becomes unpopular because of some news that comes out about him, then what does the house of cards that are building this hype machine around Dogecoin happen? It collapses all in a day. The volatility works both ways. That's if something can move up as fast as a cryptocurrency, can move just as fast to the downside. Like the average implied volatility for Bitcoin is about 4% plus or minus a day, and for all the other currencies, that's a lot more. That's Yeah, so I mean, that's kind of shows you, like, by comparison, the stock market, the average return is about 7 to 10% per year, depending on whether you're in a phase of multiple expansion or earnings-driven growth. So that shows you just the degree of risk is just a complete magnitude. And I can understand why people feel that way, is because a lot of people do feel like they've been left behind, not just in terms of fear of missing out, but just because of our economic inequality in our society. They feel like they have to gamble to catch up.
Yeah.
And that's usually a bad idea. If you do any investments usually based on that logic tend not to work out well. Like the classic example last cycle was housing markets. A lot of people bought a house in marginal cities out like in like the far remote exurbs of major cities, and because they thought they would permanently be priced out of the city they actually want to live in. But those outlying, less popular neighborhoods were where the housing market fell the hardest when it crashed. There wasn't a core demand of people actually wanting to be there. They were just speculating on higher prices. And yeah, I'd like to see what happens to Bitcoin and cryptocurrency in a world where you have the Fed actually raising interest rates, or inflation get high enough that the bond market puts some real pressure on cap rates. We haven't really seen a real the last time we had somewhat of a rate hiking cycle with cryptocurrency, Bitcoin did not do very well, and that was 2018. So keep that in mind as well.
Yeah. So we're coming out of, like you said, like with the vaccines, things are open, especially LA. Like we have things opening up. There's some countries that are like don't have any masks. So do you see anything on the horizon that is interesting to you as a head or an investor or micro strategist?
I would say what is interesting to me right now, longer term, is I still like what's going on in a lot of the commodities markets and international equities. The U.S. for the most part trades at a substantial premium to international markets in terms of valuations. I think a lot of those reasons are somewhat justified due to the fact that we've gotten a lot faster in terms of vaccinating our population and reopening our economy than the rest of the world. But eventually they're going to catch up. And when they do, there will be a lot of money to be made, I think, investing overseas. And in the commodities market, too, is a product of international demand for goods and services. And the U.S. is running at full steam. But when you have large swaths of Europe and Asia and Latin America being locked down still, their lack of consumption is what's kept the commodity market from really taking off. So those are two that look interesting to me in the longer term, are the commodity market and international equities.
Oh, that's amazing. And so also so the cryptocurrencies is just like something that people should be very, really look at that. Like how much can you, gamble to lose if it's just very
don't
volatile.
Put like your retirement fund in cryptocurrency. Like if you like, say for example, you used to bet on sports and now you want to have something a little more juice, then cryptocurrency is probably a better bet because the expected value is probably more positive than it would be from a binary gamble. Or instead of, say, using your money that you normally spend out if you're in a place that still is kind of closed, and a night out on the town at a bar, that you could use that money you would spend on a bar tab on crypto. And if I'm correct and like Bitcoin corrects substantially, then you won't really be too miserable about losing money. It won't hurt you. But if you put something that you're banking on, or you need to buy a house or save for retirement, it's not the place to put your money.
Yeah, and with bank interest rates so low, like is real estate still the like top priority where people can just see a long-term hold investment grow?
It depends where. Real estate is very geographically variant in terms of its performance.
Mm-hmm.
Like, do I expect real estate to do well in vacation markets such as like Palm Springs or Florida, or maybe or Napa, they're like, yeah, I probably will, because a lot of people who wanted to live there but couldn't because of their jobs will be able to. Will markets such as New York and San Francisco, where people live because they had to for jobs, will those do as well? Probably not. So it's, and that even once this reopening theme is finished, there's a lot of local socio-political factors that decide what real estate markets will outperform on an absolute versus a relative basis. And then there's the whole dilemma of when foreclosures will be allowed again, because a lot of the supply has been constrained in the short term due to foreclosures not being allowed. And if that law is kept on the books, that would be a major boost for housing. And whenever they start allowing foreclosures again, that'll probably normalize the market and won't be such a frenzy. But again, whether or not to buy a house is very dependent on somebody's individual situation. So I can't really give like any specific advice on what each listener should do, but just know that it's very dependent on where you live.
Yeah, and a lot of people have said that they're spending their stimulus checks on like, investing, but like when July comes, they're not going to have that safety net. So it's going to be interesting to see what happens July, August, September, once people who haven't paid their rent since March, or only 25% of the rent, still don't have a job. It's just going to be very interesting to see.
I don't think those are the people who are buying stocks. Same with the housing dilemma. Like, the housing prices are not going up because, like, people say, oh, there's all these people who are in the service industry are out of their jobs. How can housing go up? It's not the same people. The people who are buying houses are white-collar professionals. The people who are putting their stimulus check into stocks are people who aren't living paycheck to paycheck, or at least that's what I've gotten out of that based on the data, the conclusion I've drawn. So I don't think those are one and the same, if you know what I mean.
And so what about, you said oil has gone up, because like in Los Angeles, oil is already back up to $4.59 a barrel. So do you have any
I think you're referring to gasoline prices of $4.59 a gallon.
Yes, gasoline.
Gas prices are somewhat different from oil because those have to do with local refinery bottlenecks, as well as our state government's high gasoline taxes. So yeah, like gas is much cheaper, say in like Oregon or New Jersey or Colorado, probably like half the price in California because of those variables. Yeah. But sorry, what were you saying?
Well, I was going to see, like, do you see that, like, with the laws are supposedly in 2030 that everything has to be battery a car? Like, do you see anything between the gasoline and like battery cars? Like, is that something to watch?
Longer term, but that's 10 years out, and that's probably with oil. Eventually, people will stop using oil or use it at a lot less than they used to. And oil demand in the first world had peaked in the mid 2000s, like around 2006. So, but at the same time, I think these people who assume that everybody's going to be an electric car by the end of the decade and that nobody will be using, all the gas stations will be gone by 2030, are a little bit ahead of the game. So I think in the short term, there's going to be a lot more demand for oil over the next 3 to 5 years than the market expects. But in the longer term, it'll probably start to taper off. That's kind of my view on that. Does that answer your question?
Yeah, and but I also wonder, like, because batteries are toxic, and what do you do? Where do you put the batteries after you're done? Because a lot of people don't think about the environmental impact. So, like, waste management, it seems like it's always going to be something interesting to look into as well, right?
Well, yeah, I mean, I think a lot of the utilities are attractive longer term. And I think a lot of the waste management companies trade somewhat like utilities, because in a world of inflation, which is my base case in the longer term, that you're going to see higher inflation rates than historically. Utilities and waste management companies can pass the costs on better than other goods, because what are you going to do? Not have your garbage taken out or not have power? Mm-hmm. And they generally pay generous dividends too. So those companies probably have the chance to outperform in a more inflationary environment, just because like they have a pretty strong level of inelastic demand.
Yeah, so many interesting things. And Nicholas, what can you update our audience with your new YouTube channel where they can like reach out
It's
to
still
you?
my same YouTube channel. It's called Ask a Macro Strategist. You could search that on YouTube. You could also find me on Twitter at Nicholas-Pardini. Yeah, if you have any questions for me, feel free to comment on the videos or email me at askthefundmanager@gmail.com.
Yay. So anything in closing before we go? We're just so excited to have you on the show. We could ask you tons of questions.
Yeah, I mean, I think that probably in the short term, the things look pretty calm in the markets. But I mean, starting this summer, it'll probably be time to be a little bit more cautious in a variety of different investments.
So more bear. So like maybe starting to be a bear market, right?
I don't know, honestly. It's really tricky because on one side, you have valuations really high, and but the other side, you have a lot of liquidity from the central bank pertaining a perpetual demand for assets and interest rates being held down below than where they would be in a normalized economic situation. So it really matters which one of those variables is stronger and what the broad psychology is. But yeah, I mean, I think the market will be will be weaker. I just don't. Bear market territory is a 20% decline, and I'm not sure if that will happen by year end. That's why. But I think you will. I think that the market will at least slow down, if not start to roll over in the second half of the year.
Yeah. Well, thank you so much for joining us today, Nicholas. I'm so excited to have you back on the show. Can't wait for you. So check out our Film Addicts and our Moguls. Please listen for his episode coming up. And thank you so much for being on the show today, Nicholas.
You're welcome. Thanks for having me.